Hello and welcome to our special here from the World Economic Forum in Davos. I'm Shereen Bhan, and as we always do, we've got the team from IHS Markit joining us now. Dan Yergin, Nariman Bhavresh and Carlos Pascual. Always a pleasure. Thanks very much for joining us. Mr. Yergin, let me start by asking you, the mood here is one of caution and pessimism. I know what you think. You believe that it's a little overdone, but I'm going to get to you in just a second. But let me ask you on what you think are the key pulls and pressures this year.
Well, I think a couple of things. One is I think that we'll hear from Nariman on this, but I think there is a sense of recession watch here. I think the second thing is the absence of people who are here, and the fact that the American government isn't here is a sign of the dysfunctionality in the United States. And I think the third thing that strikes me is this theme of disruption. Disruption in the multilateral order, disruption in technologies, disruptions in governments, and so all of that is here in this kind of rather subdued, lower key mood. You don't feel the exuberance about technology that you feel sometimes at Davos.
And certainly not the exuberance that one felt in 2018. So it's been a significant drop in just the last 12 months.
Well, some people would say that's because Donald Trump isn't here. You know, he created a lot of excitement and a lot of controversy when he's here. So far, there isn't a sense there's a lot of controversy, at least yet. So I think it's more kind of reflective and thinking about these larger changes and just what is happening to the international order.
I'll come to the international order and multilateralism in just a second. But Nariman, when we spoke briefly yesterday, you said that you think the pessimism is overdone. Why do you feel so?
Well, I think what we've noticed in the past is whenever a stock market takes a big dive, as it did recently, anybody in the financial sector tends to very quickly jump to a recession forecast, whereas the industrial sort of companies tend to be a little more circumspect, shall we say. And we're seeing that now. So a lot of the financial types are here, talking about recession, whereas the non-financial types, not so much. I think our view is that, yes, things are slowing, no question, but that we're still a long ways from a recession. So right now we're saying maybe 1 in 3 chance of a recession in 2019, but then higher in 2020, 2021.
What would you be most concerned about?
Well, I think a policy mistake is one of the biggest worries here, primarily in terms of trade, certainly. I mean, we've all talked about that. But the other is that should we, for whatever reason, go into a recession, we don't have a lot of room to maneuver in terms of monetary policy, in terms of lowering interest rates, in terms of fiscal policy, we have very little room to maneuver. So the worry is that we're running out of ammunition to be able to fight recessions.
So while we probably don't have much room in terms of a more accommodative monetary policy, but do you see the fact that we might not see as many rate hikes as was being anticipated previously?
Well, clearly the Fed is very responsive to what's going on in the marketplace, and so our view is they will pause probably for 6 months, so no rate hikes probably in the first half of the year. But we still think the fundamentals in the U.S. would argue for a couple of rate hikes at the end of the year. But even then, interest rates are going to be very low, and what we think of as the neutral rate, it'll be below the neutral rates. So still sort of below the neutral zone, or maybe at worst in the neutral zone. So in that sense, I don't view monetary policy, even in the U.S., as being particularly tight.
So, Shereen, I think there's one thing that be said, though. I think it was important, I think Nariman would agree with this, that the Fed needed to show that it was acting not in response to Donald Trump beating up on them, but rather that they are reading the data. And so you got a lot of the different Fed governors all expressing the concern. That was very important for underlying confidence.
Oh, I think so.
I totally agree with that, yeah.
So, Carlos, geopolitical risks continue to dominate conversation here, and that was the case pretty much last year as well. What's changed and what would worry you?
I think that right now instability and insecurity has become a dominant theme, and one of the factors is the way the dominant leaders in individual countries and the main powers around the world, the United States, Russia, China, Saudi Arabia, Turkey, now Mexico, now Brazil, are dominated by individuals who are shaping a vision of governance around themselves. And that personal vision starts to create volatility. We're all human beings, and when that human volatility starts to get into national politics and into global politics, people worry. And the biggest piece of concern, I think, that everybody has is what happens in trade between the United States and China. Because it is so big that it dominates perspectives on economic growth throughout the world, what's going to happen in equity markets, what will happen in commodity markets. It's going to affect India, it's going to affect the United States. And in the end, we all become spectators centers very much around two people, President Trump and President Xi, and that's really dominated this uncertainty about the global marketplace and about global politics.
Since you talked about India and China, the US and China, I was interviewing the former RBI Governor Raghuram Rajan here this morning, and he said that the US-China battle isn't just about tariffs. It's much bigger than that. It's about supremacy. In that context, A, how hopeful do you feel about them being able to thrash out some sort of a trade agreement? And B, what will be the implications for the global economy if these two continue to bicker?
Yeah, I think you're absolutely right. The negotiations aren't just about one aspect of a trade agreement, and we shouldn't expect that this is going to be finally resolved because there are many, many issues that are involved. There are questions of Chinese exports to the world. There are issues of intellectual property, of cybersecurity, of market access, but there are also questions about hard security issues, the South China Sea, the question of influence throughout the world. And these are issues that are going to play themselves out over a period of time. So the best hope, I think, that we all have is that both China and the United States can reach an agreement where at the end of that process, they can each say that they did something which is good for their individual countries, that maintains some degree of economic stability in the international system. You saw what happened with, let's say, oil prices after the IMF announced that there could be a 1.6% decrease in economic growth in China if the United States applied all of the tariffs. Price of oil went from $86 a barrel to about $60 a barrel. There were other factors. This was one of the biggest ones. And I think that what we're all trying to find is a way for there to be an understanding around trade that doesn't result in yet more damage to global economic growth, recognizing that it isn't all going to be resolved in a one-time discussion.
I want to pick up on the point that Carlos made that world over, you're seeing policy being driven on account of an individual's idea of what the world is, and that's shaping decisions. Christine Lagarde here spoke about a new multilateral order, new multilateralism. How hopeful do you feel in this current context of being able to get to that, achieve that?
I think it's difficult right now, given the personalities involved, given this administration's hostility to multilateralism. It wants bilateralism. And also, I think, given the changes we're seeing in the Democratic Party, as it moves to the left, it's progressive. It's also less interested in international institutions and more inward-looking. So I think finding a right framework, it's interesting, of course, and of great interest to India, is the discussion here about Belt and Road, there's an alternative vocabulary, which is the Indo-Pacific, which is responsive to India's growing role in the world. But I think also one thing that stands out, we've talked about oil prices going up and then going down. The fact is that India still imports over 80% of its oil. And so India's own reform agenda is very important for its economic growth, including continuing to reform the energy sector.
Specifically, yes,
add
of course.
Something here. I think globalization has gone in big swings. In other words, we had a lot of it in the late 19th century. Then it sort of went into abeyance and has come back. So it could be, and this is possibly a pessimistic view, that we're in one of those periods where we're seeing some abeyance, if you will, or some pulling back from globalization. But my own sense is that this particular hiatus may not be so long as the earlier ones, partly because of strong market forces. There's a lot of market forces pushing for globalization of services, globalization of data. These are things that I think are powerful forces that are going to be very hard to stop.
But you do hear, it's interesting, you even hear people sort of decoupling between the United States and China, breaking the supply chains, because part of the whole textbook, the playbook of globalization was supply chains. And now, in a sense, those supply chains are under assault. And I find a lot of the companies here are kind of rethinking or thinking that they might have to rethink their strategy and their playbook.
I think one of the things that we're all starting to see is this difference between multilateralism in an institutional sense and multilateralism that occurs on the level of companies. And if you look at it on an institutional sense, you have the UN in crisis because you have Russia, China, and the United States essentially using their veto power in the Security Council to be able to annul any significant action that could be taken there. You get organizations like the Organization of Security and Cooperation in Europe, which can't come to a conclusion on issues like Russia and Ukraine because it requires a consensus among all of the parties, and they can't reach consensus. You have the European Union that's in risk because of what's happening with Brexit, the decline in the influence of Germany and France with their own problems. And so the institutions that have been the backbone of international governance are really going through a crisis, and even WTO, because of the questions that we've been talking about on trade, are facing a real problem as well. So this distinction between the new multilateralism, if you look at it from a perspective of institutions, it's not going anywhere right now. If you look at it from a perspective of companies, they're trying to reinvent what they do and how they do it, because the old ways of the old perspectives that they have are starting to become questioned, and this idea of reaching out and outsourcing and producing in places such as China has come into a whole series of new risks. So it has to be reinvented.
You know, speaking of this reinvention, one of the things that we saw post the 2008 financial crisis was central banks around the world working together. There was sort of concerted effort on the part of central banks to work through the problem. In the current context, when we're talking about, you know, the order, so to speak, the multilateral order not working, what kind of challenges will that throw up if, in fact, we do go down a bumpier road?
Yeah, I think my sense is I'm fairly confident that the central banks, forgetting the other institutions that Carlos talked about, which I agree with him about, but the central banks are always talking to one another. They're always looking for ways to cooperate, as they did in 2008, 2009. And if the crisis is bad enough, that's a qualification, obviously, I suspect we will see more cooperation among the central banks.
But I think what is striking, of course, coming out of the financial crisis, central banks, their cooperation was really critical. I think, as I think about it, that central banks don't have quite the same authority, the same legitimacy. They're more subject to political pressures. And I think coming out of the crisis, there was a notion that the G20 was going to be the new board of directors for the world economy. And it turned out that the G20 is more a talking shop. And so, you know, that there isn't the same sense of congruence among policymakers.
If I could just disagree with my colleague, Dan.
Please do. Feel free to. We love that.
No, in the sense that, I mean, he's right, obviously, in what he says, but I think should a crisis occur, I think a lot of governments are very happy to turn to central banks, because they don't, I mean, the governments themselves don't have the tools to fight recession, certainly from a fiscal policy perspective.
But as you point out, central banks may not have the tools that they did going into the crisis.
Well, that is true, except that I think they could go back to buying massive amounts of bonds. That option is still very much there. Again, all in a crisis. I'm not suggesting they're going to do that anytime.
And you believe we're nowhere close to that point.
Exactly.
But let's just talk about what we're seeing happen as far as commodity prices are concerned, and specifically crude. And we talked about 2018 and the kind of volatility that we've seen. What's the broad outlook now, given what the U.S. is being able to do on the production side and balancing that with the production cuts from Russia and OPEC?
Well, it is going to be the reactivity between the two of them. I mean, the U.S. is going to continue to grow. The U.S. will probably add 1.5 million barrels of supply this year. India will be importing more energy from the United States than it has in the past. And the other producers will have to adapt to it. What happened in October wasn't very well known, but the United States became the world's #1 oil producer. That was a big thing to have happen, and it's going to continue. And so the others are responding to it. When we look at demand, this goes back to talking about China growth, talking about world growth. We look at demand, we see it growing about 1.5 million barrels a day this year. And that entire growth could be taken care of by the United States. So there's going to be a kind of, I guess we'll say, a continuing dialectic between the growth in the U.S., how producers in the U.S. respond to price volatility, and what the exporters do, because, of course, as they cut to try and sustain prices, that also is a license to domestic U.S. producers to step up, put their foot on the gas.
So what would be the floor and what would be the ceiling?
Well, I think that the range, I mean, we've seen prices above and below, but it seems that it sort of would be within this $60 to $80 range. Last year, with all of the volatility up and down, the average price for Brent was $71 a barrel. So we're expecting this year will be in the high 60s. But some of these factors we've been talking about, the trade battles, what happens to economic growth, what's really happened to China, will certainly have a big impact. But we are going to see more supply from the U.S. also because some of the bottlenecks that have kept U.S. production from flowing into the world market, those bottlenecks are going to be eliminated in 2019.
And I think what Dan said just reinforces the earlier point on demand and the issues between China and the United States, because that fundamentally will have an impact on global economic growth and demand and will affect everybody. As Dan said, there's going to be enough growth in U.S. supply just to meet the business as usual projection on demand growth globally. So if you have a collapse in demand, we're going to find ourselves in a situation that really is potentially pushing down the price of oil, and that's something that everybody's going to be looking out for. What happens in those trade negotiations, and what does that mean for commodity prices? What does it mean for equity prices?
Absolutely. Well, softer commodity prices, good news for markets like India. Dan, you've spent a fair amount of time in and out of India in 2018. We've got all of the Indian oil and gas companies here in Davos sort of pitching the India story. What more needs to be done in order for us to really attract big-ticket FDI?
I think that is the question about when are you going to get large foreign investment? And the question that we hear from the international companies, we hear from people, is we want to have predictability, we want reliability, we want to know we're going to be able to get a return. And a lot of progress has been made in that direction, and we've seen the bidding rounds. We hope there'll be another bidding round actually at our CERAWeek conference in Houston, attracting interest, building confidence, but it's not something that gets built overnight, but it is, India needs the infusion of technology, it needs the infusion of money and investment in order to get a better balance, which it doesn't have now in its oil and gas supplies, particularly its oil supplies, because otherwise its balance of payments are very vulnerable to what happens to the price of oil. So it's better to have that money spent in India than spent going over to some other country. So I think a lot's been done, but a lot more needs to be done over the next couple of years, and then I think you'll start to see the confidence. But right now companies have a lot of options, a lot of places they can go and invest their money. But I'd say one thing that really is in India's favor is that, a few years ago it was all about China, that's the growth market. Now India is really seen as a growth market. It has a young population. It's going to be on the growth turnpike for a long time, it's hoped, and that therefore people see India as a place that they want to be, which was not so high on the agenda a few years ago, but that's significant. And that's why it's very significant that the leaders of the Indian oil industry, oil and gas industry are here. They have a message that's very important because, in a way, a lot of the future of the oil and gas industry globally is going to be in India.
Well, we certainly hope so. Let me end then by asking all three of you the number one risk and the number one opportunity for 2019. Carlos, I'll start with you.
The number one risk is what happens in U.S.-China trade. I mentioned it before. The number one opportunity...
Not Brexit, though.
Well, it's Brexit is a risk, but by far what happens in U.S.-China is the biggest issue. The number one opportunity, I'm going to say something a little bit unusual, but the tensions in the Middle East have come to a point where maybe finally there's enough of a consensus that we can get some form of a ceasefire and stability in Yemen, and I would hope to see that just given the nature of that tragedy.
Okay.
Yeah, I would agree with Carlos that an escalating trade war, whether it's between the U.S. and China, which is the most likely, but the U.S. and other parts of the world, is very high risk. It could do serious damage to global growth. I think that the big opportunities are still in the emerging world. India, for example, even Brazil, depending on what Mr. Bolsonaro says today in terms of the kind of policies he might put in place. So I think there are some nice opportunities, potential nice opportunities in the emerging world.
Well, emerging world, hopefully will deliver on that potential. I'll give you the final say, Dan.
Well, I think I will build on what my two colleagues say. I'd say that the risks are not U.S.-China, but just beyond trade, the whole deterioration and the risk of an incident in the relationship. So I think that's what I would look at as from what we can see today, as the biggest risk. The biggest opportunities is getting back and ensuring that we don't have a recession and that we have good economic growth in 2019, that's the biggest opportunity, and that will benefit everyone in the world.
Well, I would hope that Nariman is proven right when he says that the pessimism might be overdone, and I'm sure that that's what the markets would hope for as well. As always, thank you very much, Dan Jurgen, Nariman Bhavresh and Carlos Pascual for joining us here on CNBC TV 18 in Davos.